everyone, and welcome to today's market snapshot. My name's Craig Erlam, Senior Market Analyst at OANDA. Now, apologies for not doing a video for the last week or so. It's been quite a busy period, so I haven't actually had the time to put one of these out. But hopefully they should become quite a regular thing once again. What I'm going to do today, slightly different format. I'm going to go through some charts, and as I touch on different things, that I'll mention any newsworthy points. I think it may hopefully help with the smoothness of the recording, but also help to speed things up a little bit and not waste too much time. We can start with euro dollar. I'll go through a number of charts today, considering we haven't done any videos recently. You can see with euro dollar we are trading back around the 106s right now. I do potentially think this does have a little bit more room to run. I think one of the things that really halted the trade today, we have broadly in the market seen dollar pairing its recent gains. Of course, it is trading now at a 13.5-year high on a trade weighted basis. And I think we've probably seen a little bit of profit taking. I think that was pretty evident by the moves which we saw earlier on in the session. I do also think it is a logical little profit taking point right now, not necessarily because of what the markets are doing, but more so because based on the markets, we are seeing the implied probability now of a Fed rate hike for December being at 95%. That is a huge number, well above the 70% the Fed apparently needs to raise interest rates, or wants before it raises interest rates. But it's so close to 100% at this stage that you wonder how much more the dollar has to run, but only in the short term. That is something I desperately want to stress. I do think we potentially see a little bit more dollar strength, which we'll go into in a second, but I think next year rate hike expectations are currently too low. So I think the longer term dollar move still has some legs to it. We're currently seeing one rate hike priced in for next year, which personally I just don't think is enough, even before you take into consideration what Donald Trump is going to do in terms of spending plans and what kind of an impact that will have from an inflationary standpoint. I think the markets just aren't pricing in enough. But the other thing that makes me think it's a dead cat bounce is the look of the chart. Yes, we did see a rally up to around 106.50 from the lows of around 105.70. But really, in the grand scheme of things, this is a relatively low move, and that is instantly being sold into. So this is what's called a dead cat bounce. It's when you see a retracement in a move, but the retracement itself is actually quite small. You can see that we saw, I think, was it 9 or 10 day stretch of euro dollar losses. Now I think that I saw something the other day that this is the first time we've seen this kind of a stretch in euro dollar since the 4 days before Lehman happened. I do not think for a second that this is in any way connected, so don't be frightened or scared by any of these comparisons. People are always looking for extravagant ways to express just how significant a move is, and I don't think this is any different on this occasion. Like I say, I think based on the dead cat bounce that we've had today, talking of extravagant ways of expressing yourself with relation to things, I do think this has got a little bit further to run. You can stretch out here, and I think could be looking back into this major support zone that we had since March of last year, between around 104.50 and 105.30. I think we will potentially see it finding a bit of a floor at this point, because like I say, it has been quite a dramatic sell-off since the Trump election. Now you can look, if you look at the stochastic and the MACD here, you'd suggest that potentially what we're seeing is building momentum. So why couldn't we see a breakthrough the 104.50 levels? But if we look at the 4-hour chart, you can see that the last low we made did come on significantly lower momentum, and you can see on the MACD histogram, for example, momentum has been falling. Now that in itself isn't a reversal signal, but it would suggest that we are potentially finding a bottom after what has been quite a prolonged period of strength for the US dollar, and therefore weakness for euro dollar. Like I say, I think we could potentially see further downside, but I am skeptical as to how much further we can go in this. The pound has been far more resilient to the dollar's strength, but equally that has come as a result. That I do think that the large driver of that is the fact that it was oversold. We've seen huge weakness in the pound since Brexit, and that had to come to a head at some point. There was going to reach a point when we were going to start seeing longer term traders saying, hold on a second, this is now sold off quite considerably. How much further can it possibly go? Would I rather be short of this in the long term, or do I think there's more value in the upside? And I think there is an argument to say that the potentially at least in the next few months prior to Article 50 being triggered and the data potentially starting to deteriorate, I think there is an argument to be said that the value potentially is becoming more prevalent in the upside more so than to the downside. And I think the fact that we've seen the pound more resilient to the dollar would potentially suggest that the market is viewing things in broadly the same manner. I think it's also been helped by the fact that we saw the High Court in the UK reject the government's wishes to invoke Article 50 without it being passed through Parliament. I think that's had an impact, and the changing plans of the Bank of England, I think, has had an impact as well. The fact that the economy has performed better than the Bank of England was expecting, it's therefore unlikely, it's therefore extremely unlikely at this stage to cut interest rates again this year. But even in the early part of next year, that looks unlikely, and that has been bullish for the pound as well. I think the key level for me here is the key line in the sand, really. We're looking at this 127 to 120, well, 120, 750 to 128.50 zone here, prior zone of support here before we broke through here just in the lead up to the flash crash. We've got the two moving averages, which is the 55 and 89 day simple moving averages here, and it's also the 61.8% retracement of the most recent downswing from the swing high to lows. A break above there would suggest the market has become a lot more bullish, at which point I think we'd have to be looking back towards these 134 highs, if I'm perfectly honest. These was the previous zone of resistance, and when you break through a major support, turn resistance zone, you've got to, in my view, then the next obvious levels start to become these 133.50s to 134.50s, and that again is where you see the 200 and 233 moving averages coming back into play. Euro sterling again is another area where we are seeing some more sterling strength. We have seen another break lower today in the pair, so another break higher for the pound. We've come into support around these 85 levels, which is a logical area of support, given that we have seen a little bit of support and resistance around here previously. But for me, though, the fact that we've broken through this major zone of support here between 86 and 87, we've broken through the moving averages. I do think we are potentially going to see a move back towards these 82.50s to 83.50s. Again, a prior zone of support between July and September, and then you've also got the potential of the moving averages 200 and 233 moving average band providing additional support below. So I think that's your next major zone of support, although you could see little areas of support along the way. The next one potentially being around the 84, but like I say, 82.50 to 83.50 for me is the next major zone of support here. A very interesting pair right recently has been dollar yen. Now, dollar yen, we have seen a massive surge. This has come as a combination of the dollar strength, but also the Bank of Japan's new policy, which kind of went under the radar. And I think that may have been a mistake when you've got a rising interest rate expectations from the Federal Reserve, which effectively steepens the yield curve because people's inflation expectations further down the road are higher, so they think interest rates are going to be higher. And you've got the Bank of Japan, which has altered its monetary policy slightly from increasing its monetary base by 80 trillion yen a year to maintaining the 10-year yield at 0%, which is where it currently is. Then the rising interest rate differential that you get between the US and the Bank of Japan and Japan leads to a more bullish outlook for the dollar yen pair. So we've seen these two opposing outlooks for interest rates for US and Japan, and I think that's what's really led this surge. Now, we saw the warning signs when we had the break above the Ichimoku cloud. Frustratingly, the sell-off on election night meant that we did see a move temporarily below the bottom of the Ichimoku cloud to around just above 101 when it became apparent that Donald Trump was going to take the presidency, which initially sparked a lot of risk aversion in the markets. But from there, we have seen this massive surge through. We're currently around 111, and I do think we are at a major resistance zone here. Not necessarily in the long term. In the longer term, I wouldn't be surprised if we could see this continue moving up towards these 115.50s, 116 type levels. But again, as with the euro dollar, we have seen a major move here in the dollar yen, and I think we could potentially be looking at a retracement. Got major past support and resistance zone here between 111 and say 112.50 and 112. We've got the 50% retracement level around 112.50, and that is for the entire move from the highs back in June 2015 through to the lows of June 2016. So I think this major support zone could potentially prompt some profit taking and potentially prompt a bit of a correction to the downside. We're already seeing signs that these higher highs are being made on falling momentum. The MACD histogram, the MACD moving averages, and also the stochastic showing some divergences here. Again, that doesn't necessarily signal that we're going to see an instant move to the downside, because in the same way with what we've seen in the euro dollar today, we've seen some weakness in the dollar, but that has been bought into straight away. So I think we could potentially see another move higher into these 111, 112 levels. But I do wonder whether we have the momentum enough to break through what is, in my view, a very important resistance zone. Brent and WTI, of course, have the same story, really dominating here. We've got the fact we've had a big rally today on the back of hopes that an OPEC deal can be done when they meet, when OPEC meets in 9 days' time. There has been a constant talking up of the potential for a deal to happen. I still remain skeptical, especially with a deal that's actually going to be carried out. But as we saw in the lead up to the Algiers meeting, it doesn't really matter what we think the outcome is going to be. The market seems to want to rally into these meetings in case a deal does happen. The market rallied on a number of other occasions as well, where it eventually appeared to be wrong. We saw the selling here from middle of October through to middle of November on the disappointment that a deal didn't appear to be materializing. OPEC are again talking this up. Vladimir Putin, the Russian president today, talking up the potential for a deal, and I think that's what the market's really responded to today. Again, I may be skeptical, and I personally don't think, even if a deal is agreed on the 30th, I think it's going to be a very loose deal, and I'm skeptical as to whether it will be kept to. But markets are going to rally on what it hopes or what it expects to happen, and that's all that matters. So given that information, we are around the 50 fib level here, and yet we haven't really found too much resistance. And the rally does seem to be quite strong at this stage. So personally, while I remain skeptical on a deal, I think we could potentially see some more upside materializing here. I think 49 offers your next major level of resistance in Brent crude. We've got the trend line, which we broke below finally from January this year. That providing potential resistance. We've also got the 61.8 fib level around 49.35 as well. So I think this is an important zone of resistance. Beyond that, we're looking at around $50 a barrel, which I wouldn't be surprised again if we see that hit, if we do see this deal continue to be talked up by different members of OPEC. Again, $48 in WTI is a similar level. That's a 61.8 fib level here. We've already broken back above the ascending trend line here, which suggests momentum is very much with the bulls right now, and I'll be surprised, to be honest, at this stage to see that $48 hold because of the momentum which is gathered. I think we'd be looking in the short to medium, in the short term, back towards $48.60, $49 a barrel, and I think we could even push on from there if expectations continue to grow. In keeping with the wanting to keep this video short, and now already being at 13 minutes, I think we'll call it there for the day. We'll do another video tomorrow, and I'll try and catch you guys up on a number of other instruments with the charts. You'll notice that there wasn't very much in terms of economic events today. The only notable event was ECB President Mario Draghi speaking, and it seems there's very little has come from that at this stage. We did hear from Stanley Fischer as well, but there was nothing new to come from the Vice Chair of the Fed. Really is just indicating that December very much remains on the looks like it's likely to be the point at which we see lift off from the Federal Reserve once again. So again, hope that was useful. We'll look to continue these videos on a daily basis, and hopefully we won't have a gap like we've just had for the last week. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.